I'm going to go ahead and start the recording now.
Cool.
We'll wait another minute or two for people to join up.
Sounds good. How's it going, guys? Snowing. Cool. Yeah, we just got back from a ski trip and now back at it.
It's been an interesting week of weather across the country, that's for sure. Negative 50 wind chill up in the northern states.
And then
Like
what was that? The
Chicago.
vortex?
Yeah. Polar vortex.
All right, cool. I'll go ahead and mute myself and just let me know if you need anything, Trav.
Cool.
All right, brother. Appreciate it.
All right, everyone. Welcome to our weekly stock market update, February 5th, 2019. So it's again a pretty interesting time in the market. We've got a lot of earnings. Looks like actually Snapchat just reported here after hours, and the stock's making a big move. But yeah, we continue this strong trend of equity markets being up again after last week. So we were up about 1.5% on the S&P. About the same on the NASDAQ. Europe was a little flatter. I think Asia was roughly in line with the U.S. increase at about 1.5%. Crude oil was up about 3%, and then rates were slightly lower. So it was just a real continuation of what we saw in prior weeks. And you can see here on this chart of the S&P, we've got a pretty hard V-bottom bounce. And, we really haven't had any down weeks so far this year, which is pretty unusual. So I'm getting a lot more cautious on the market overall, but the single stocks continue to move a lot on individual earnings reports, of which we had a lot last week. So we'll talk about a few of those. Overall, I'm getting a lot more cautious and starting to raise a bit more cash in the portfolio as things run up. So, but still on the hunt for interesting opportunities. Even in markets that are flat, we'll see a lot of different opportunities in single stocks throughout the year. So just trying to hunt for those. Last week in terms of macro data, the Fed here in the U.S. held rates steady as expected, and their comments were actually pretty dovish, meaning it doesn't look like they're going to be as aggressive on rate increases as they had been, and they're going to be following the data a lot more closely. And really, they just indicated that they're aware of the risks that are out there, including the government shutdown, the trade wars, and increases in mortgage rates and things like that, and some weakness in the housing sector. So the Fed appears to, have its thinking caps on and really understand where the market's headed and what they need to do. So that was a good sign. But in terms of other macro data that we got, housing continues to look somewhat weak. Mortgage applications were down 3% week over week last week. But countering that, we see the employment data continuing to be pretty strong. ADP's employment data had, I think, a net 200,000 jobs added last week. The non-farm payrolls jobs data had about 300,000 new jobs added. There was a spike in initial unemployment claims data last week, 50,000 spike from 200,000 to 250K. We had said on last week's update that it had actually set a record for the last few years at only 199,000 initial jobless claims the prior week. So we came off of a really, really strong reading, the first that had been that low in like 40 or 50 years. So there was a spike back up to about the 250K level for initial claims. So we'll be watching that. Nothing too scary there, but overall, the employment data continues to look pretty good here in the U.S. We had some ISM PMI data, both for the manufacturing sector and the non-manufacturing sector. The manufacturing sector there actually looked decent. The non-manufacturing sector is growing, but just at a lower pace. And we also saw the consumer confidence numbers look pretty good. And the Redbook retail sales numbers look pretty good as well. Now, all of these data series from a macro perspective are fitting with the trend that we've seen over the last couple of weeks, which is they are still growing, but showing lower growth rates than we saw last year. And so, yeah, I mean, what we're seeing is just a continuation of the same trend, and cautiously optimistic on the economy overall. But again, we're not going to get too overstretched in terms of what we're doing with our investing decisions in this kind of environment, because there's a lot of murkiness in terms of where we're headed over the next year. And that's also actually, so far in this earnings season, it's been mirrored in the earnings data and earnings projections for 2019 as well. So sitting here today, we have about half of the S&P 500 companies have reported earnings for Q4. And, earnings growth for Q4 is at about 15%. Now, last year's earnings growth rates were affected pretty heavily by the tax cuts in the US. So that's why you see these abnormal, high teens to mid-teens growth rates in earnings. And, we do expect that it's going to moderate. And, actually, the Q4 revenue growth is only at about 5.7% for the half of the S&P that's reported so far. So revenue growth is a lot more muted for Q4. And really, when we look forward, when we look at what companies are saying about 2019, that's where some concerns start to come in. Q1 2019's earning estimates are actually showing a slight decline versus Q1 of 2018. So analysts are expecting for the first quarter of 2019, in aggregate for the S&P 500, they're actually expecting a slight decline in earnings. So, and then they're expecting a low single-digit growth for the rest of 2019. So the expectations for 2019 earnings are fairly muted, and they've actually come down in the last couple of months, which is what we'd expect given the economic data and what the market did in the last quarter of 2018. But it's interesting to see that. Sometimes I like to look at these earnings scorecard reports. There's a couple that are put out. FactSet has a pretty good one. You can see that was just put out on February 1st. And they talk about the trends in terms of, aggregate companies reporting of earnings and earnings guidance and where the valuation of the S&P is currently. So these are really good reports to look through. And again, this just shows what I was just talking about, that the change in earnings per share forecasts for Q1 2019 has come down quite a bit. You do see in prior years that often does happen because analysts get too aggressive about next year's earnings targets. So you've seen that in other years as well. But this is the first time in a while that we've seen the earnings estimates come down so much. So that's an interesting trend to see. And again, analysts are actually expecting a slightly negative trend in earnings for the first quarter of 2019, which is usually not great for the market. But overall, the market's trading, S&P 500 is trading at about 16 times forward earnings, which is, right around the 5-year average. So in terms of valuation, we're not really in any aggressive situation, undervalued or overvalued here. So again, it's one of these situations where the market could go either direction over the next couple of months. And I'm not sticking my neck out in terms of market direction. I'm more focused on finding individual companies that have interesting catalysts over the next couple of years. So here's another earnings scorecard by Lipper, which is a division of Thomson Reuters. So they break it down by sector, and you can see by sector, the number or percentage of companies that are reporting above expectations and what the surprises look like in terms of earnings. They actually break out FANG here. So it's interesting to see that Facebook, Apple, Netflix, Google are growing at about twice the rate of the S&P 5, the rest of the S&P 500, actually more than 2x. So, that's interesting to watch the trends with those large companies as well, because they've been such bellwethers for the rest of the market. But yeah, so these earnings scorecards I think are really interesting to look at, and I can send these links out later. But in terms of individual companies that reported last week that we were watching, Eagle Materials from our watch list, that the results there were somewhat weak. We saw double-digit declines in their concrete sales volumes and high single-digit declines in their other businesses like wallboard and paperboard and aggregates and even fracking sand. So the stock was pretty flat, and there wasn't a whole lot going on there. And And so that's one I'll just continue to watch and wait to see if we've got some trading opportunities going forward. But the stock's fairly in line with what its fundamentals are doing right now. So we're just kind of in wait and see mode there. Pulte Homes, one of the home builders we're watching, also the results were also somewhat weak, as expected though with home builders here. There was a 11% decline in their home sales volumes year over year, but that was offset by price increases in most of their markets. So, Pulte was still able to deliver a year-over-year revenue increase. What's interesting about Pulte, though, is that they really have been disciplined about their capital allocation over the last couple of years. So they've actually been continuing to decrease their share count through buybacks, and that's allowed them to grow earnings quite a bit. So earnings growth was actually 30% year over year, even though sales growth was single digits. So the stock was up a little bit last week, but it trades for about 8 times this year's expected earnings. So it's really a pretty cheap stock. And they're doing some interesting things on their land acquisition too. This is a home builder who, in decades past, would buy up a lot of land on spec for building future homes. What they're doing now is over 50% of their land is actually through land options. So they have the option to actually walk away from some of those land acquisition deals. So their portfolio of land is a lot less risky than it used to be. So it's a company that I think in the next upturn or the next positive economic environment could see really, really huge gains. And so we'll just look to see if we can accumulate this at the right prices. Back here in the low 20s, I think is a really good range. If you can get Pulte for less than 7 times forward earnings, that's a pretty compelling level. So yeah, that was Pulte. As most of you probably saw, Apple reported last week. They were one of the big bellwethers we were watching in the tech sector, and that stock performed really well last week on the increase in their not their increase, but the beat of expectations. So the sales are actually down year over year, I think by 4%. But when you looked at their performance relative to expectations, they had already pre-warned about this quarter being weaker than expected on lower iPhone shipments. But it turned out that it was less bad than people had expected. And so, the stock had already been down 40% of the last few months. And so, you got a nice gap up here after earnings last week. It's interesting if you dig into, their actual earnings results, what's happening in the underlying segments. So you can look at this, in terms of geographic reporting segments. You can also look at it by category. And that's really interesting. China was something that we called out in the last weekly update for Apple. And, China was down a 26% revenue decline year over year. So that actually makes up most of the revenue decline for the quarter was from China. You can see that Americas was still growing year over year. Europe was down a bit, and Japan was down slightly. But really, China was the big driver of the revenue decline. And as a product, iPhone was the big decliner. So that's where they saw most of their weakness. And that, a lot of that has to do with the trade war. And there are some questions as to what happens to Apple going forward in China. But again, this is a company that has reduced its share count. As you can see from its income statement here, they've reduced their share count, I believe, by 8% year over year in 2018. So they're returning a lot of this capital to shareholders, and they're buying back their stock at lower prices to help drive EPS growth. So you can see here that even though net income was actually down in this quarter, the earnings per share, so the earnings per shareholder, is actually up because they were able to reduce their share count last year. So smart capital allocation, and they're able to actually increase earnings year over year. So Apple beat expectations, and the stock was up 6% on the earnings results, and continues to be up this week. So, it's not one that I'm getting super aggressive or involved in right now, but it's just interesting to see as these companies report, how they do relative to expectations. Facebook was another one that reported and beat expectations, and Facebook, has been a big gap up here. I believe it was up 12% on the
Oh, hey guys, I think we lost Travis. Give me 1 second. Yeah, it looks like he got disconnected, so give us 1 second here.
All right. Is everyone here? Looks like I may have lost you there for a second.
Yep, I hear you. Can you guys hear Trav?
Yeah, let's
Cool.
let's get this going again. Okay. Sorry about that, everyone. All right. Hopefully we are back in action here. So talking about Facebook again, we saw that the worries about their user base and their revenue growth were, I wouldn't say put to bed forever, but certainly the expectations of potential user declines and revenue growth really moderating a lot didn't really happen this quarter. Now, one thing I'm watching again is the increase in CapEx. I mean, they're spending so much more than they were, and they really haven't given a whole lot of insight into why. And so that's concerning. The increase in costs and increase in CapEx is something that is a little bit concerning for me. There's even with this robust revenue growth, they're having to invest a lot more in hiring and improving their systems to try to beat back some of the negative sentiments and negativity that they're getting from the press. So 2019 is probably a little bit of a year of transition for Facebook. It's good to see that they're still growing revenue so robustly, but profit growth is going to be pretty muted. And so that's one that I'll be watching to see, how that business evolves over the next couple of quarters. But it was interesting to see that positive reaction in the stock. So another company that reported was Tesla. This is everyone's favorite battleground stock. And what was interesting about Tesla was that they had this they have their, let's see if I can pull up their earnings letter from Q4. They put out this Q4 update letter like they do every quarter, right? And they talk about, oh yeah, we're market share for the Model 3 is breaking all these records, and it's the highest premium vehicle sales in the US, and we're profitable still, and all this stuff. Not once do they mention that the CFO is leaving. They literally announced that the CFO, Deepak Ahuja, was leaving at the very end of the conference call at I think it was 5:30 Central Time, the very, very end of the conference call. I mean, it's just, funny stuff like that. And the stock was actually up a little bit after hours until they announced that. And then the stock was down after hours. And, they just continue to be a company that doesn't really seem to be able to execute well. And the management team is in constant disarray. Now the stock has rallied. It's not one that I really am keen to get involved with because there's just so much noise. And I think there's actually some issues with fraud. There was a report that came out last week from a local Buffalo newspaper talking about their solar panel factory in Buffalo that got $750 million worth of government incentives and hasn't hired all the people that they said they were going to hire. And employees reporting that basically the whole thing is in disarray and that they faked a bunch of PR stunts where news crews were out there to see how the factory is going, and they basically erected walls around parts of the factory so that the press couldn't see that there wasn't really actually as much manufacturing going on as they claimed and things like that. So there's a lot of noise around Tesla. And then, if you're trading it, just be careful, because I think you could wake up one day and this thing is down 50%. It's interesting to note that they appointed a 34-year-old as CFO. This is a $50 billion market cap company. You don't hire an inexperienced 34-year-old. You go out and you have an executive firm do a search, and you find someone who's been CFO or is CAO of a major company before. You don't put a 34-year-old in charge. So just some funky stuff happening with that one. But in any case, there were some other giants like Amazon, and we saw Google yesterday reporting. Amazon was a slight beat, but stock was actually down. There were some concerns about India, the market, them having to get out of India as a market. India put in some restrictions on foreign firms like Amazon and Walmart. So we saw some relatively muted reactions, even though Amazon's still growing revenue 20% year over year. AWS, which is their cloud division, is still growing at over 45% a year, which is pretty amazing considering how large that division already is. So Amazon really didn't do a whole lot after earnings. It was down slightly, but again, it's sort of had a lot of expectation priced into the stock already, and so if you look at a longer term chart, obviously like this is a stock that's had an incredible run over the last couple of years, and so it's finally sort of pulling back in terms of its expectations going forward. One who's sort of the opposite is GE, right? So we had this stock has had a pretty brutal last couple of years as the divisions have underperformed. They've taken on more debt, and there's a lot of concerns about the future of GE being a viable concern. And that actually, in the last earnings report, was priced in. The negativity was such that any little bit of positive news that we got was going to send the stock higher. So that's what we saw. The analysts actually were pretty mixed on this. There were some analysts that came out after earnings and said they didn't believe the pop in the stock was warranted. You got a 15% pop after the earnings release, and there were analysts that said that really wasn't warranted. There were some other analysts that came out with like a $12 price target. So GE is one that I haven't really done the work, and I'm not getting involved with at this point, but it's just sort of another example of how these stocks, after a certain point, even if they're fundamentally not performing, super well, if the expectations are such that they're so low, you can get these really nice stock rallies. So, we saw that similar move in Overstock as well, which had a nice pop. We were talking about that in the channel last week. I don't think that there's a lot happening with their platform really right now, tZERO, but it was enough. The stock was so highly shorted that it was enough to send the stock up like 50% in a couple weeks, just because they announced that they were launching this platform that they've been talking about forever, right? So again, the stock market's really all about expectations relative to the actual performance of the company. So and that's really it on what we saw last week. There's more single stocks we could talk about if y'all are interested in, but we'll be watching. There's a lot more companies that report this week as well. We get companies like Tableau, Disney, EA, and Take-Two. We have Snap after hours today, which just reported. Skyworks Solutions, Zendesk. You've got GM and Spotify. Spotify's actually on our watch list. You've got GoPro and Sonos, Expedia, IAC. You've got Mohawk, Twitter, Philip Morris, Grubhub. We've got Fiat, which is on our watch list. Fiat Chrysler reports on Thursday. So there's a lot more earnings reports this week that we'll be watching that will have effects on a lot of single stocks. And then in terms of macro data this week, we're going to be watching retail sales. The balance of trade report comes out tomorrow, so showing what the current account deficit looks like in the U.S. We'll get some Fed speeches on Wednesday, so we'll get some more info out of how the Fed governors are thinking about interest rates. And then our usual jobless claims numbers on Thursday. And then next Monday, we get personal income and spending, and then the advanced GDP estimate for Q4. So both of those will be relatively important. And then we get the inflation data, the core PCE data as well for December, which is always important to watch. So other than that, we have a State of the Union speech tonight. I don't even know how to think about that one. Who knows what will be said? And, I imagine hopefully there won't be much impact on the stock market, but you can never tell with this administration, right? So we'll see if there's anything there that moves the market. But other than that, in terms of watch list updates, we talked about last week, Dropbox. I issued a trade alert on Dropbox. Dropbox and Box are interesting. We actually got an upgrade on Box today by an analyst, and that stock was up 10%. So, Box and Dropbox are competitors. They're stocks I both like. Box has been on our watch list as well. I think Box is probably a buyout target, Box focuses a little bit more on the enterprise. So they have bigger enterprise customers, large companies, as opposed to Dropbox, which does do some enterprise sales, but it's definitely more of a B2C play where they're selling to individual consumers as well. So the reason that I got so interested I've been interested in Box and Dropbox for a while, but the reason that I issued a trade alert on Dropbox last week was, there's a company called DocuSign, which is a $8 billion market cap company, right? And they focus on e-signatures and document management. And, DocuSign is, a company that's done really well, obviously, but is given a lot of credit for future growth. And it's a company that really is in a competitive space. And so, you're paying $8 billion to be a DocuSign investor, whereas Dropbox just acquired a company, HelloSign, for $200 million that does a lot of the same things that DocuSign does. And right after the announcement, Dropbox really didn't move on the day of the announcement, and still trading in the low 20s. It actually hadn't rallied that much in terms of relative to a lot of the other technology stocks that it's sold off in Q4. Dropbox really had only rallied, I think, like less than 10% year to date. Until the last couple of days when it saw a couple of nice pops. But, this is a stock that's still trading at a relatively cheap valuation of about 20 times free cash flow, 2019 expected free cash flow, which is a really cheap multiple for a company that's growing revenue at 25%. So this to me was interesting. Being able to acquire HelloSign, which is often, a lot of people think HelloSign actually is a better user experience than DocuSign. So you've got a business that could potentially be worth a couple $1 billion, and it's not reflected in Dropbox stock. So that to me was the catalyst to finally say, Dropbox is cheap, but I didn't really have a catalyst before. Now this HelloSign acquisition becomes the catalyst that I think could drive Dropbox shares a lot higher this year. As people and analysts particularly begin to think about how this can add value to Dropbox over time, that to me became really the compelling catalyst. So yeah, is it still a good buy today? I think this is a pretty good price still at 25. I really like it low 20s, high teens, but it probably doesn't get back there unless we get a big market sell-off event. So I think you can definitely make money from here. I think Dropbox longer term is probably $35, $40, $45 stock in a year or two. And, we talked about this a little bit in the channel, but if you look at, let's see if I can pull up their executive comp info. So they actually structured the executive comp for a lot of the executives to be, let me see if I can find it, to be such that, and probably actually isn't in the S1. Let's see. Well, I'll find that for you guys later and post it in the channel again. But essentially, there's compensation shares that have been awarded to management that only vest in the event that the stock price is actually above a certain level. And mostly those stock prices are well above $30, $35, $40 a share to trigger the executive options. So the executives at Dropbox have pretty big incentives to drive the share price over $30, $40 a share over the next couple of years. So, so I always like when executives are aligned with shareholders in that way. And yeah, I don't remember exactly what filing that was in, but I can look that up. So Box and Dropbox are looking pretty good right now. It was nice to see that upgrade on Box today. Again, I think they may get acquired this year. They're often rumored as an acquisition target. But yeah, so another one that I'm watching, and we've talked about this before, but these Fannie Mae preferred stocks, right? These are ones that I think could be worth potentially 25. Their par value is $25 a share. So they traded down as low as like $4 or so in the past, but now that it looks like Fannie and Freddie Mac are going to be reprivatized by the government, they're seeing some action. And actually the common stock of Fannie Mae, like we talked about, has really been, going nuts in the last couple of weeks. Basically has been about 2 to 2.5x upside. Now, I think the common stock could be worth 0. So this one is a lot higher it's a lot higher risk to buy the common stock. Now, preferred stocks should have some security over common stock in the capital structure, meaning like preferred shareholders should get part of the recapitalization, or at least they are entitled to it before anything gets given to the common stockholders here. So when you look at the preferred stocks here, their upside may only be maybe capped at 25, but they're a lot more likely to get shares in the new recapitalized entity. And a lot of people believe these will go back to being worth par, which is $25 in this case. So, you've got something that trades for today about $9 that could be worth 25 when all this is said and done. Now, there are a few share classes, preferred share classes with different tickers. This one, some of the more illiquid ones like this, FNMAJ, trade for about $8 a share today. And the more liquid ones like FNMAS trade for about $9 a share. So you get a discount on these ones that are a little bit illiquid. And when these get back down to kind of the $6-7 range, or if they get back to that level, I will be buying these again. I was buying in kind of the $5.50 to $6 level late last year because you have a 5x upside potential. And once they get back down to that $6-7 level, you get 4x upside. I think is still, especially now that we have an event that's showing that, or news that's showing that these companies are likely to get recapitalized. Like, when you look at the news, you've got a new head of the FHFA, the Federal Housing Finance Agency, and they're really moving towards reprivatizing these. Last year, there wasn't much news around that, but with the change in the FHFA director this year, that's why we've got all of a sudden these things moving, because we've got this new news that finally they're going to really work towards reprivatizing this. So, even at like $6-7, the risk reward, you go from, if you were buying last year, you had 5x upside, but you didn't have the certainty that the new FHA director was going to be positive about recapitalizing these. Now you've got a news event that leads you to believe the probability is actually probably higher than before that these things get reprivatized. And so a 4x upside is going to be, I think, a pretty compelling thing on these if they can get back down a little bit lower. So they may not get there, but I think in this $7 range, I'll be buying these Fannie preferreds again. So that's one that we'll be watching over the next couple weeks as well, pretty closely. So that's really all that I had to talk about. Would love to get to Q&A and hear what you all want to hear.
Yeah, good stuff, Trav.
Oh yeah, Deutsche Bank. So yeah, we keep hearing these rumors that, and Deutsche Bank reported last week. We keep hearing these rumors that, and the stock was down on the report. They continue to really just not. they're not doing a whole lot in terms of improving the business. They keep trying to cut costs to improve net income, but revenue keeps declining with that. So these negative news headlines are hurting them too. When things start coming out about these forced mergers with Commerzbank and things like that, or forced government takeovers, that are being rumored, it's weighing on the stock. And I think it would be incredibly stupid for the German government to do that, to merge a not so great bank with a bad bank. That they don't get better when you combine them. In fact, they probably get worse because management has to deal with a lot more, divisions that they have to manage and products that they have to manage. So I don't think that combination makes sense. And I don't think it makes sense to force Deutsche Bank into a merger when, just because its common stock value is down. We're not, they're not seeing, funds flow out. They're not having funding or liquidity crises or things like that. So it's just doesn't make sense for me to do that. Now, governments do things that don't make sense a lot. So I'm definitely paying attention, and I'm reading everything I can to figure out what's happening with those discussions. But Deutsche Bank management has come out and said that they don't believe that is a likely scenario. They don't think that that type of tie up with Commerce Bank makes any sense for their business. So, they have a pretty powerful lobby with the German government. They're going to do everything they can to not let that happen. So I'll be interested to see what happens with DB. Again, it's very high risk, high reward. It's one that I've bought a little bit of, like a 1% position size, and I'm going to just stick it in the 401k and let it ride for a couple of years. It very well may be wiped out and go to zero, but I do again think that it could have like 4 to 5x upside if it ever recovers and starts to produce good results again, because it trades for about 20 to 25% of book value, and it could easily get back to 1 times book value if things recover. So that's one where I don't like the news flow of what's happening right now, but I'm going to just hold and wait and see what happens. I'm not going to let like one rumor spook me out of the position at this point. So, but again, I'm sizing it as a very small position because of the downside risk there. So yeah. And then someone was asking about AMD. So AMD had a nice week last week and, had a nice pop off of earnings. I think this was another one that was up about 15% post earnings results. Now, we had seen NVIDIA in the prior week doing a pre-announce that looked so ugly, where, AMD's results were not nearly as bad. And, part of that is because AMD's got a bunch of new products coming out. So they've worked with TSMC to develop, some new products at the 7 nanometer level, which is basically best in class technology. NVIDIA has been playing that down, but the truth of the matter is AMD is definitely getting more of its products into like data center clients, and they're launching more consumer products this year. So they expect their year to be a lot better. And relative to NVIDIA, it's a much, much smaller company. So, you get the potential to ride this trend in AI and data science and machine learning over the next couple of years in a company that's much, much smaller, but is really part of what you could call a duopoly in graphics cards. So that's why I think a lot of people like AMD. And it doesn't look super cheap in terms of earnings because it's still not earning that much money. But again, I think if you're trying to play those trends like over a multi-year time frame, AMD does look pretty interesting. So those markets, I think, are going to be real choppy over the next several years. Like I think, autonomous cars, for instance, are one of those things where there was a lot of hype last year and the year before about how quickly that was going to come to the market. And you can see that too in the multiples of the auto manufacturers like GM and Ford and pretty much all the global auto manufacturers except for Tesla trade at like single digit PE multiples. And part of that is because people are worried about the long-term threats of autonomous driving. Well, in the near term, I think we're going to see that autonomous driving isn't nearly as far along as people think. When you look at the market leader, which is Waymo, which is a division of Google, they continue to put out a lot of interesting data around what they're doing with their pilots in Arizona, as well as other cities where they're trialing their service. And they'll say that like they're not even at level 4 yet, much less level 5, and so they're not confident enough to put those out in most situations. And so autonomous driving they're still dealing with a lot of issues that still have to be worked out. Like the science just isn't quite there yet. So I think the demand for GPUs for autonomous driving aren't really going to take off for a couple more years. So some of these trends are going to be a little bit longer term to play. And I think you'll get choppiness in NVIDIA and AMD. So I don't have an opinion on where I want to buy AMD, but I do agree that it's an interesting stock that we should probably do some more work on. So let's see what else someone asked about Overstock. Is it overpriced? It depends on what you think about the future of their crypto businesses. It's a company that, their online retail business is just not performing very well. Let's see if we can pull up some numbers real quick here. but they keep saying that they want to sell that retail business, but the truth of the matter is, like, they haven't found a buyer, and they've been talking about selling this thing for a couple of years. And so, I think it deserves a really, really low multiple of sales. So if you value the retail business at a low price to sales multiple, and then you give it some option value for its crypto businesses, where is that relative to its current market cap? I think let's check its market cap sorry, not AMD. Overstock's market cap today is roughly $500 million in market cap. And they've got a little bit of debt on the balance sheet as well. So actually let's pull up their most recent quarterly filing. You can see they've got 180 million of cash as of the third quarter, but they've got, let's see, they've got what? Actually, they don't have a ton of debt, but they are burning cash. Like, if you look at their cash flow statement, like, for instance, for the last 9 months, this is not it. If you look at their cash flow statement, for the last 9 months, they burned about 120 million from operations. And then, once you subtract some CapEx spending as well, you're looking at probably closer to 150 million over the course of 9 months of cash burn. So call it 200 million of annual cash burn. So, they only have about 200 million of cash on the balance sheet. They raised capital actually last year in an equity offering. And that's why they have cash to continue operating for the next year. But this is a business that isn't doing very well. Its core business, the retail business, is burning cash. And then you've got this crypto option, this tZERO, which, Chris and I were looking at. And, Chris, I don't know if you have any updated opinions on it, but it didn't seem like there was a whole lot happening on the platform when it launched, which is fine. You expect that. But there are other platforms that seem to have a lot better user experience already. So, whether or not tZERO turns out to be what they believe it will be, kind of is up to, it's sort of what that really will drive the stock. It's what you believe tZERO can be. So if you believe tZERO is worth $1 billion today, then Overstock's undervalued. I don't really give it that value today. I'd probably give it like 100 million or 200 million option value. And then the retail business, which I believe is doing about $1 billion of annual sales. Let's look. So, they're doing, it's actually a little bit higher than that. They're doing probably actually 1.7, 1.8 billion. I would give that no more than like a 0.5 price to sales value. So you could be looking at, somewhere around 800-900 million for that business, but it's burning cash. So if they can't sell it in the near term, you gotta reduce that by the annual cash burn. So I might give it about $500-600 million of value today. So, Overstock is probably trading at like a slight discount to, its value, if you believe that the crypto option is worth something. But again, it's hard to know where to value that today.
Yeah, and just to kind of chime in on the STO side, when we were looking at it last week, I mean, there was very little trading activity, and I believe, if I'm not mistaken, the last price that I showed, and it's really hard because their back end isn't even really like a real trading platform yet. I believe that the tokens were trading at like a 50% discount, which I'm not surprised to see. I didn't just expect all of these like accredited investors to step in and start buying right away. There's, initially probably more sellers than buyers right now for those tokens. But it's just something that I'm watching, and my first initial impressions were not impressed at all.
Yeah. Yeah. And it's going to take a while for, these security token platforms to recruit people who want to actually put their assets on these platforms, and a lot of regulatory stuff. Obviously they're preparing for all that, but I think it's going to be a long, slow grind for these exchanges to put assets on, to tokenize these assets. So it's going to be a while before I think they really generate cash flow or at least meaningful cash flow. So yeah, I'm just looking through the presentation here, the most recent earnings presentation for Overstock. I remember looking at this a couple weeks ago. See, they're talking completely, almost 100% about all of their crypto ventures, whereas the retail business is really what drives the business right now. So yeah, so this is one of the things that's interesting, right? So as recent as like Q2, the retail business wasn't even generating gross margin. So like contribution dollars, that's even before you pay for like corporate overhead. So, this is a very, very low profitability retail company, online retail company. So if you thought Amazon's margins were small in online retail, Overstock is even worse. You're talking about, even at its best, it was maybe about 100 million in annual retail contribution dollars, which is before you even account for corporate overhead, and on 1.8 billion of sales. So it's a really low low margin business. And they've actually been having some problems with customers acquisition. It got a lot more expensive in the last couple of years. There are companies like Wayfair. I don't know if anyone's familiar with Wayfair, but Wayfair is a high flying stock that is an online retailer that does a lot of the same stuff that Overstock does, except they've been executing a lot better. So Wayfair has got a $10 billion market cap, and it's really just been giving Overstock problems over the last couple of years, just taking lots of share. So Overstock has a problem competitively in its retail business, which is another reason why I'm just not convinced that they're going to get a very good price for their online retail business. And that's even assuming that they can sell it to someone. So that's really why I'm not super bullish on Overstock, but I do think it offers pretty interesting trading opportunities. And that, I think Nikki has better insight on that, but this is a very highly shorted stock. So it is potentially, a stock that can see big short squeezes. So.
Yeah, it'll be interesting to see what their first couple of quarters of revenue come from T0.
Yep.
That's kind of what I'm waiting for.
Yep. Yeah. So someone was asking about gold stocks. Chris, you've been looking at gold stocks quite a bit lately, right?
Yeah.
Price of gold.
Yeah. I mean, I've been looking at, either the gold futures or physical gold. As far as like gold miners go, I have no clue how to really play in that space. I watched an interview with a guy that runs a fund that invests in individual miners, and it seems like that can be an interesting play, but it's also super, super volatile and risky. And I think there are some gold miner ETFs out there, but I haven't played with that. I've really just been buying physical metal to kind of stack in a vault.
Yeah. Gold miners historically have not been
Oh, did we lose Travis? Cool. We'll give him a minute to hop back in. Yeah, while we're waiting on Travis to come back, I'll just say, when it comes to gold, I kind of look at that like crypto, not your keys, not your coins, right? With gold, it's kind of the same thing. Like I'm not really interested in stacking, a bunch of ETFs that are like leveraged, and you don't really know if the gold shares that you own, if there's gold actually backing that. I'd rather have it in some kind of non-bank vault, right? Like there's companies all over the world that will store your gold in these vaults that are not tied to a banking system. So in the event that there is like a banking crisis, hopefully that'll have some kind of protection. Yeah, I've also been buying some platinum. there's kind of an interesting thing fundamentally with platinum that I don't quite know how it's going to play out. Platinum is used mostly in catalytic converters, I think is their main use. And there's been speculation that palladium is going to be used more often now. And that's very much so reflected in the price. I think palladium's up in the 1300s or platinum's down around 800. So I'm not chasing palladium right now. I think it's up way too much. If you look at the historic price chart, you can see there's some pretty big like pop and flop price action moments. So if we do get like a deep pullback, I'll probably look to accumulate some of that. All right. Trav, you with us?
Yeah. Sorry, y'all. This is frustrating.
Is your internet just cutting out or?
Yeah. I can't tell if it's a Zoom problem or if it's an internet problem on my end. Everything else seems to be working.
And, okay. We'll figure it out.
Because I've literally had 0 internet problems here at the house in the last year. So I don't know. Of course, it would happen when we're broadcasting, but
no worries. We were just talking a little bit about gold.
Cool. So yeah, I don't have a strong opinion on gold prices, so I can't really get bullish on the miners, but
yeah,
I'll try to take a look and see what their balance sheets look like and their some of their earnings prospects look like for the year. But I know there was a big merger in the space recently, so I'll have to follow up on that. Let me just pop open our Q&A here. Can you guys hear me okay?
Yep.
Okay. So yeah, I think the questions that I had in the queue disappeared. If y'all have open questions.
Yeah, I'll fire some off to you. So Travis, you said that Dropbox is still in a price range where it's worth buying. Are you going to increase your position size? Or are you waiting for a dip? Would it be possible to point out your strategy to either adding or reducing your position with this example?
Yeah. Yeah. So with Dropbox, I open a starter position, which means, before I'm going to make it bigger, I need to get really deep into understanding the company and make sure that there's aren't any blind spots. And so I've been doing a little bit of work this week on that. And eventually I'm going to have a model to show you all of what I think the share price is worth. So probably on maybe 2 weekly updates from now, I'll have the Dropbox model I can share with you all. And I think that'll help illuminate, how I think about price targets too, and how I set them. But yeah, we also, I believe, let's look the Dropbox earnings. They'll be reporting, I believe, in February, like mid-February. Actually, let's just go to their investor relations site. That usually gives us the date right off the bat. So they've got their fourth quarter report will be on February 21st. I probably won't do anything with the position, especially since the stock's been running up a bit. I probably won't do anything before then. These earnings calls give you usually a lot more information about where the company's headed, especially over the next year or two. And they'll probably talk about HelloSign as well some, so we can better understand how that's going to fit into their product suite. So I probably won't do anything with the position before the earnings date in terms of sizing. But in terms of how I think about that generally, we talked a little bit about this in the channel some, but I typically start with a starter position, and that's going to be pretty small, 1 to 2% of the portfolio. And then as I get more comfortable on it and do more work and actually have a firm price target that I'll set, I can increase that to 4 or 5%, or even, if the risk reward is high enough, it could go as high as 10 or 15%. So that only happens over time though, as I get more confidence and as I do a lot more research. And so, a lot of that involves just reading through a lot of these filings. Like if you look at, what we're showing here, there's a lot of filings to look through. And there are a lot of notes to the financial statements and things like that to understand. I want to make sure that there's, for instance, like, how do I think about what cash they're going to need to pay for like the shares that they repurchase for tax withholdings of their employees, right? Like that might seem like a minor thing, but it actually has been a pretty big usage of cash for them over the last 9 months. So, really understanding different parts of the cash flow statement and how they're using their cash going forward, and what the outlook of the business looks like, the competitive situation, with them versus Box versus Google Drive and things like that. So there's just a lot more work to do to get comfort around, around where the company's headed, and just making sure I understand all the key details. Right. This is just the 10Q. You can see how, it's hundreds of pages. Now, a lot of this isn't that relevant, but certainly, like, I want to read through, the notes to the financial statements. I want to read through the management's discussion and analysis section. And then they'll have a 10K that comes out, in probably in the April timeframe, that covers last year, and that'll have even more info. So we'll want to look through that. When you have a newer IPO company like this, like Dropbox, you can often read the S1 as well, which is, the S1 is probably 300-400 pages of info. And so that'll give you a lot of the types of information that the 10K will give you. But at this point, yeah, I'm just not quite ready to make the position bigger, because I haven't done all the work necessary. So
yeah, I'll be real interested to see your work on that, Trav.
Yeah.
Cool. All right, guys. Any other questions related to any individual stocks or the overall markets? Everybody clear? Yeah, Apple and Dropbox, both, some nice bounces, and the markets, it's pretty interesting how overextended they've got from that last bounce.
Here, by the way, is the I remembered with the section on Dropbox's grants, what they call their co-founder grants. This is the stock right before the IPO. They set aside almost 15 million shares of stock to give to the CEO, Drew Houston, and the COO. So the grants will vest only after the stock price hits these targets. So you can see that once the stock price of $30, once it's above $30, then the 2 million of those 14.7 million shares will be eligible for Drew Houston, and 880,000 for I forget what his first name is, but for Ferdowski, the COO. So you can see that these, they get more and more shares as the price goes higher. So they're incentivized. They don't get any of these shares until the share price is above these types of levels. So you can see that long term, they wouldn't have set these targets if they didn't think that they could achieve them. So I imagine that management thinks that they can drive this stock to probably at least $50 or $60 over the next few years. And at least they're incentivized to do that. Now, there are things that could go wrong, but that's probably how the management team is thinking about the stock price over the next few years. And actually, this is a 10-year period post IPO. So this is essentially runs through 2027. So I wouldn't expect, a $90 share price next year, but I think the way that they're thinking about the long-term growth of the share price is illuminated through some of these co-founder grants.
Nice. Question says, what do you think of buying bonds right now? And as part of one's portfolio, is it a must to have, even under the conditions that we have right now with interest rates as low as they are?
Yeah. Bonds to me. So yeah, bonds are tricky, right? They have a place in certain portfolios, especially people who want and need income. But stocks are, bonds have had pretty low yields in the last few years, like especially investment grade bonds. And it just hasn't been something that has really excited me. I do think it has a place in certain portfolios, especially longer term portfolios, but it's not something that I'm aggressively chasing right now. And that's partially because interest rates have been really low, but also you know, a lot of the work that you do to value companies also applies to bonds, but the difference is, you know, you can get pretty significant upside in the stock, whereas like a lot of times your best case upside in a bond is to earn 5% a year, which again may be right for you if you're a lower risk, you know, income based type of investor, or if you have a significant portion of your portfolio to put to that type of investing. For me, I'm a bit more aggressive, so you know, it's not something that I'm super focused on right now. Once in a while, I will, if I'm looking at a distressed company and their bonds are yielding, you know, 25% on current prices, then potentially sometimes I will look to buy that company's bonds rather than the equity. So Fannie Mae is a kind of an example of that, right? A preferred stock is kind of a hybrid between a bond and a common stock. In terms of capital structure, it sits right in between. You know, if a company goes bankrupt, its bonds are going to be paid off first, then its preferred stock, and then the common stock if anything's left over, right? So preferred stock in a way is like that. It's above the common stock in the capital structure, and it can often even have an income component. So that's why with the Fannie situation, I've got a preferred stock that could potentially, you know, used to trade close to $25 at par. The income payments have been suspended for now, but again, the preferred stock could one day within the next maybe year or two be worth $25 a share again. That's the kind of thing that I like to see, where it may be a distressed situation with some upside and a little bit more safety versus the common stock. So I've seen that situation occasionally too in bonds, where distressed companies' bonds will trade off and give a high enough yield that I think it's a more compelling risk reward to buy the bonds. I don't really see any of those situations today, but I once in a while will take a look and find those. And so, but yeah, my style is different too. So if you're looking for a lower risk bond type play for your portfolio, I think that's totally fine. But I would probably go more for like a diversified bond fund with a low expense ratio, and that's where I would start.
Good stuff. All right. Well, Trav, any other kind of final thoughts or projections or ideas for the coming week?
Yeah, well, just really, like I said, going to be watching the earnings reports again and following up on the work that we need to do on some of these positions that we've mentioned over the last couple of weeks. So Dropbox, obviously, we were just talking about, and there's a couple others that we've mentioned that we need to, especially with earnings results and getting new information in and new financials. I'm going to go back and update how I'm thinking about some of these positions and positions on the watch list. So really just in work mode, and we'll be watching all the things that we just talked about. Again, Fannie might be a potential trade if those preferred stocks continue to trade off a little bit. That's one that I'm looking at that could be probably the nearest term trigger. So, and yeah, that's
awesome. Okay. Well, good stuff, Trav. Thanks a lot, man. I always appreciate your insight, and definitely looking forward to the Dropbox kind of deep dive and model. And yeah, we'll just keep watching this week.
Sounds great. Thanks, everyone.
Take care, guys.